Imagine you're holding stock in a massive tech giant, right? You open up their highly anticipated quarterly earnings report, and you see this sleepy single-digit 7% revenue growth.
Yeah, which is usually a death knell.
Exactly. I mean, if you're a growth-oriented retail investor, your instinct is probably to just hit the sell button immediately. You look at that top-line number and assume, well, the narrative is dead, the momentum is gone, and the company has just aged into this stagnant utility.
Right.
But if you did that with Bilibili today, you'd completely miss the fact that hiding just a few lines further down the income statement, their operating profits just absolutely exploded by like over 10 times.
It's wild. It is the ultimate test of looking past the headline. I mean, when a company known globally as the YouTube of China, a cultural behemoth built on anime, gaming, youth subcultures, reports only 7% top-line growth in Q1 2026, the algorithms and the casual analysts are just going to write it off.
Totally.
But the underlying mechanics revealed in this transcript show a business that is quietly, almost ruthlessly, printing cash.
And that's exactly why we're here. Welcome to another Talk Ticker style deep dive. We are taking a scalpel to Bilibili's Q1 earnings today. Ticker symbol BILI.
Yeah, we're stripping away the corporate fluff today.
Every bit of it. The PR spin, the sanitized executive summaries, we're throwing all that out to look at the raw financial machinery. Our mission for you today is simple. We're translating the Wall Street jargon into the actionable reality of what this actually means for your portfolio, and we're doing it fast.
Right, because there's a bizarre gap right now between their revenue and their profits.
Huge gap. We're going to dissect the massive demographic shift happening in their user base. We'll evaluate their honestly very aggressive spending on AI infrastructure. And finally, look at their gaming division, which frankly is showing some real structural cracks.
Yeah, the overarching narrative here is a complete paradigm shift in how this company operates. I mean, for years, Bilibili was valued on this growth at all costs matrix.
Right, just grab all the users.
Exactly. It was about acquiring daily active users, dominating the cultural zeitgeist, capturing the attention of Gen Z. Monetization was almost like an afterthought, a secondary concern to market share. But what this Q1 transcript proves is that the era of subsidizing growth is over. This is strictly an execution and efficiency play now.
So let's start right there with those headline numbers, the expectations versus the reality of the balance sheet. So Bilibili reported total revenue of 7.5 billion RMB for the first quarter.
Which is roughly $1 billion US, depending on currency fluctuation.
Yeah, right, $1 billion. And that top line revenue is up 7% year over year. Now, as an investor looking for alpha, I'll be honest, 7% does not get my blood pumping.
No, it sounds like a mature legacy telecommunications company.
Right, not a vibrant video and gaming platform.
But that's exactly why the subsequent metrics are so critical to understand. Revenue only grew 7%, but their gross profit hit 2.8 billion RMB, which is up 9% year over year. And their gross margin hit 37.1%. Now, that specific metric, the 37.1%, is basically the linchpin of the bullish thesis right now.
Why that specific number?
Because it marks their 15th consecutive quarter of margin expansion.
Wait, let's pause on that. 15 consecutive quarters.
Yeah, nearly 4 straight years.
That's insane. We are talking about every single 3-month period, management has somehow figured out a way to squeeze a slightly higher percentage of profit out of their core operations.
Exactly.
In the tech sector, specifically for a video hosting platform where, bandwidth and server costs are notoriously brutal, that kind of sustained margin expansion is incredibly rare.
It really is. It requires just an iron grip on operational efficiency. I mean, think about the unit economics of streaming high-definition video to 115 million daily active users.
It's got to be massive.
It is. Historically, every extra minute of watch time meant an incremental increase in content delivery network or CDN costs. But Bilibili has spent the last 4 years really optimizing their dynamic encoding.
Oh, interesting.
Yeah, they've been negotiating better leverage over telecom providers and shifting their creator revenue sharing models. They basically decoupled their user growth from their infrastructure costs.
I look at it kind of like a massive toll road. Like years ago, Bilibili built this multi-lane digital highway. And to get people to use it, they let everyone drive on it for pennies or even for free, right? They were subsidizing the maintenance costs just to build up the traffic volume.
Right, losing money on every car to build monopoly on attention.
Exactly. But now the highway is packed. And instead of spending billions to build more lanes, they've installed these sophisticated AI-driven fast-track lanes. And they're charging premium tolls to the commercial drivers and the advertisers who, frankly, now rely on that route.
That is a great way to put it.
The fixed costs of the highway are already paid for, so every new premium toll just drops straight to the bottom line.
Yeah, that is the textbook definition of operational leverage, and you can see vividly in their net profit. I mean, just a year ago, in Q1 of 2025, they posted an 11 million RMB net loss. They were still bleeding cash.
Right.
But in Q1 of 2026, they swung to a positive 202 million RMB net profit.
Wow.
And honestly, even that understates their cash generation. If you look at their adjusted net profit, which gives us a much truer picture of the actual cash generating power of the business, it jumped a massive 62% year over year.
62%.
Yeah, up to 585 million RMB.
Okay, so we have 7% top line growth translating into 62% bottom line growth. That's huge. But here is my pushback for you.
Let's hear it.
Operational leverage is fantastic, obviously, but you cannot cut your way to infinite growth. You just can't. Eventually, you run out of fat to trim. So if your top line is only inching up at 7%, doesn't that put a hard ceiling on the stock's future valuation?
It's a fair question.
Like, you can't just be an efficiency play forever in the tech world. At some point, you need new money actually entering the ecosystem.
And that is the exact tension that analysts were probing during the Q&A segment of the earnings call. Management's defense is that the 7% blended revenue growth kind of masks a massive internal reallocation of where that money is coming from.
What do you mean?
Well, Bilibili is not a monolith. It's an amalgamation of different segments. You've got value-added services, advertising, games, and IP derivatives. To really understand their future, you have to look at which specific segments are surging and which are shrinking.
Which brings us perfectly to the absolute star of the quarter, advertising.
Oh, yeah.
The numbers here, frankly, they look like they belong to a completely different company. Ad revenues surged 30% year over year to 2.6 billion RMB.
30% is massive.
It is. Advertising now makes up roughly 35% of their total revenue. So think about this. If the overall company is growing at 7% and a segment making up a third of the business is growing at 30%.
Right. That means the ad division is essentially carrying the entire platform's growth on its back right now.
Exactly. It's doing all the heavy fire.
It is the primary engine of their profitability. And to really grasp the mechanics behind that 30% surge, you have to look at the demographic data management revealed. The CEO, Rui Chen, highlighted that the average Bilibili user is now 26.5 years old.
See, this is a fascinating cultural and financial pivot to me, because Bilibili was built on ACG, right? Anime, comic, and games.
Yeah, entirely youth culture.
It was the platform for teenagers, high schoolers, college kids. It was heavily reliant on these highly niche subcultures, those chaotic bullet screen comments, and just really raw user-generated content.
But here's the thing. The teenage user base from 2016 has simply aged up.
They grew up.
They graduated university, they entered the workforce. A 26-year-old is no longer relying on their parents' allowance to buy digital cosmetics and a mobile game.
Right.
They're earning an actual salary. They're entering the phase of household formation. They're renting apartments, buying cars, getting married, making major consumer electronic purchases. Marketers refer to this as capturing household decision-making power.
But wait, if they aged up, why are they still on Bilibili?
Usually when a platform is that defined by youth culture, the users abandon it when they hit their mid-20s because it starts to feel juvenile. They move on to whatever the adult platform is.
And that's exactly why Bilibili is such an interesting case study, because they successfully transitioned their content algorithm alongside that aging user base.
So they didn't just keep feeding them anime.
No, not at all. They heavily promoted and incentivized knowledge-based content, technology reviews, lifestyle vlogs, financial analysis. The platform matured with the user. And the proof is in the engagement. The daily time spent on the platform hit a record 119 minutes per user in Q1.
119 minutes. That is essentially 2 solid hours of engagement every single day.
Across a user base of 115 million daily active users. The scale of human attention there is just staggering.
And it is long-form attention. This is a critical distinction for the ad ecosystem. Like, short-form video platforms might capture 2 hours of your day, but it's fragmented into hundreds of little 15-second clips.
Right, you swipe past an ad instantly.
Exactly. Bilibili captures attention in 15, 30, or 45-minute blocks. If you are an automotive brand trying to sell a new EV, or a home appliance manufacturer trying to sell a $2,000 smart refrigerator, You cannot effectively convey your value proposition in a 15-second dance video.
You just can't.
You need a trusted creator doing a deep dive review.
Which perfectly explains the sector-specific ad growth they reported. Ad spending from digital products, home appliances, and the automotive sector all grew over 30% year over year.
Yeah, they're targeting high-ticket items.
But the most revealing statistic from the call, for me at least, was regarding home decoration.
Well, the forward bookings.
Yes. So home decoration ad sales increased by a modest 3.5% in Q1. But management specifically noted that as they moved into Q2, they saw forward bookings for that specific category jump by more than 130% year over year.
130% jump in home decor ads on a platform historically known for anime. I mean, it proves the demographic thesis completely.
It's like watching a mall transition from a teen arcade where kids spend quarters into a high-end furniture store where adults are buying couches.
Exactly.
The advertisers have realized that the 26-year-old needs a couch, and they are willing to pay a premium to get in front of them right at that moment when they are forming their adult brand loyalties.
But demographics are only half the equation for this advertising surge. I mean, a wealthy user base is pretty much useless to advertisers if the platform cannot effectively match the ad to the intent.
Right, you have to actually convert them.
Yeah. The real accelerant here, and the reason ad growth outpaced overall revenue so drastically, is their aggressive overhaul of their advertising infrastructure using AI.
Oh boy, AI. Every single tech earnings call in the last 2 years has just been saturated with AI buzzwords. It is exhausting trying to separate the vaporware from actual operational improvements.
It really is.
But Bilibili actually provided hard, quantifiable metrics on how AI is impacting their bottom line.
They did. They stated that AI-generated ad creatives have doubled their click-through rates. And furthermore, management noted a 25% increase in CTCVR for performance-based ads.
Okay, we need to investigate that mechanism because a 25% jump in click-through conversion rate is massive.
It is.
We know regular CTR can be manipulated. You know, you make the ad flashier, you use clickbait, you get more clicks.
It's easy.
But the conversion rate means the user clicked the ad and then actually took the desired action. They bought the product, they downloaded the app, or they submitted a lead generation form. So how is Bilibili's specific AI implementation driving a 25% increase in actual conversions?
It comes down to how their large language models process those 119 minutes of daily watch time. Think about traditional recommendation algorithms. They rely on collaborative filtering, right?
Like, user A likes this video, user B likes this video, so show user A the ad user B clicked.
Exactly. It's a lagging indicator based on really broad behavioral buckets. But Bilibili's new AI infrastructure is parsing the actual semantic content of the videos being watched.
Okay.
It's cross-referencing that with the user's historical engagement and dynamically generating the ad creative on the fly to match the precise context of the user's current session.
Wait, give me a hypothetical of how that actually looks in practice for an advertiser. Like, let's say I'm that EV manufacturer we talked about.
Sure. So under the old system, you give Bilibili an ad for your new EV, and you tell them to target males aged 25 to 35 who watch technology videos.
Right, just a standard media buy.
Yeah, a shotgun approach. Bilibili serves that exact same static video ad to millions of users in that demographic. But with the current AI implementation, it's totally different. You give Bilibili your budget, your 3D assets of the car, and your core messaging. And then the AI takes over completely. The AI identifies a 26-year-old user who has spent the last 3 days watching videos about camping gear and road trips. So the AI dynamically generates an ad creative showing your EV driving through a Saurus, highlighting the cargo space and the battery range for off-grid camping.
Oh, wow.
But simultaneously, the AI identifies another 26-year-old who mostly watches personal finance and commuting hacks. It generates a completely different creative for the exact same car, focusing on the tax rebates and the autonomous driving features for heavy traffic.
That is wild. The ad is custom tailored not just to the demographic, but to the real-time psychological intent of the user.
Exactly. And because the robot is doing this at scale, dynamically optimizing millions of variations per second, the conversion rate skyrockets.
Which explains why management reported that advertisers' AI budgets on the platform surged 170% year over year.
170%.
Yeah. They have reached an 85% penetration rate for automated ad spending.
Because the advertisers are essentially surrendering control. They're handing over the budget and saying, your algorithm is far more efficient at finding my buyer than my internal marketing team. just optimized for the final sale.
And when you can prove to an advertiser that you can double their efficiency, you gain immense pricing power.
Precisely. This is how Bilibili expands its margins without needing a massive influx of new users. They are simply extracting twice as much value from the existing traffic.
It is an incredibly compelling narrative for the ad division. But look, if we are providing a truly objective deep dive for the retail investor, we have to flip the ledger. We need to look at the structural cracks.
Let's do it.
Because while the ad division grew by 30%, the division that originally built this company, gaming, went backward.
Yes, it did. Gaming revenue fell 12% year over year, down to 1.5 billion RMB. For a company that was once viewed primarily as a gaming publisher, with a video platform attached, a 12% decline in the core division is a glaring red flag.
Whenever a division drops 12%, management always has a defense prepared, right?
Always.
Their explanation on the call centered heavily on this concept of a high base. They argued that Q1 of last year was artificially inflated by a massive blockbuster launch, so the year-over-year comparison looks unfairly negative.
Yeah, they specifically cited the launch of Sanmu in early 2025. It was a massive initial hit, generating a huge surge upfront revenue. So in Q1 of 2026, they simply didn't have a comparable blockbuster release.
Right.
Therefore, mathematically, the revenue shrinks.
Look, I understand the calendar math, but as an investor, relying on the high base excuse feels like a deflection from a deeper issue. It highlights the inherent volatility of the gaming business model compared to the steady, predictable, AI-optimized drip of advertising revenue.
Yeah, it's night and day.
You are constantly on a treadmill where you have to manufacture massive hits just to keep revenue flat. If you miss one quarter, the whole top line suffers.
It is the hit-driven entertainment model, identical to a movie studio. I mean, if you don't have an Avengers-level release this summer, your box office numbers collapse compared to last year. Management tried to counter this narrative by emphasizing their long-term operation strategy for legacy games.
Oh, right. They mentioned Fate Grand Order.
Yeah, they were very quick to point out that Fate Grand Order is approaching its 10th anniversary, and Azure Lane is approaching its 9th.
Which, to be fair, is undeniably impressive. A 10-year lifespan in the hyper-competitive mobile gacha market is practically geologic time.
It really is.
It proves they know how to manage communities, run live ops, and keep whales engaged for a decade. But milking a 10-year-old game is a defensive strategy. It stops the bleeding, but it doesn't drive 20% future growth.
Exactly. You cannot build a growth thesis on 10-year-old titles slowly decaying. You need a robust pipeline. And the pressure on their upcoming pipeline is immense right now.
What have they got coming up?
Well, the transcript detailed several catalysts that investors absolutely must monitor. They soft-launched N-Card in April, which they described as a poker mechanism hero game, with an official aggressive launch slated for July.
A poker mechanism hero game. Okay, that is a highly specific niche.
Very niche.
It's likely relying on heavy gacha mechanics for character acquisition combined with strategic card battle or gameplay. It monetizes very well if it catches on, but man, it is a saturated genre.
It is. They also have a simulation game, or SLG, called Sanwang coming late this year. Now, this is notable because SLGs typically target an older, wealthier demographic.
Oh, the exact 26-and-a-half-year-olds we were just discussing.
Exactly. They're designing games specifically for their aging user base, focusing on high-end 3D graphics and complex strategy rather than quick-twitch action. And finally, they highlighted LumiMaster, which has this cozy art style and is aimed at a global launch in Q4.
That global launch aspect is crucial. The Chinese domestic gaming market is heavily regulated and just fiercely competitive, with Tencent and NetEase suffocating the space. Expanding LumiMaster globally is clearly an attempt to break out of that geographic constraint.
Yeah, they also mentioned adapting Escape from Stockholm, which is a PC game that sold 4 million copies for mobile and console. So they're trying to build cross-platform franchises. But your skepticism earlier is totally warranted.
Right.
If N-Card launches in July and fails to crack the top 20 grossing charts, and if LumiMaster stumbles in Q4, that 12% decline will no longer be written off as a high base.
No, absolutely not.
It will be priced in as a structural, permanent decline in their gaming division.
Which puts an almost unbearable burden on the advertising division. You cannot maintain a 15-quarter streak of margin expansion if a core revenue pillar is constantly collapsing.
Right.
Which actually brings us to the most critical part of this analysis, capital allocation. How is management spending their cash to ensure the AI engine keeps running while trying to fix this gaming pipeline?
This was addressed in the forward guidance provided by the CFO, Sam Fan, and it involves a massive, highly specific commitment to AI infrastructure. He stated that Bilibili is projecting an extra 1 billion RMB in capital expenditure this year, specifically allocated for AI servers and computing power.
1 billion RMB. That is a massive capital outlay for a company whose total quarterly revenue is 7.5 billion. As an investor, you really have to scrutinize how that capital is treated on the balance sheet.
Yet it all comes down to the accounting treatment of CapEx versus OpEx. When you spend 1 billion RMB on AI servers, which are likely high-end GPUs required for training and inferencing those dynamic ad models we discussed earlier, that is capital expenditure.
CapEx.
Right. You are buying a physical asset. You do not take the 1 billion R&D hit to your profit and loss statement all at once. You capitalize the asset and depreciate it over its useful life, usually 3 to 5 years for server hardware.
So it softens an immediate blow to the quarterly profit numbers, but I want to be clear, it is still real cash leaving the company's treasury today.
Precisely. The cash is gone, but the accounting impact is smoothed out over time. However, running those servers, the electricity, the cooling, the engineering talent to maintain them, that is OpEx, operating expenses.
And that hits the P&L immediately.
Exactly. Management acknowledged that this 1 billion RMB CapEx investment is going to result in roughly a 500 million RMB hit to the P&L this year through a combination of that depreciation and the increased running costs.
A 500 million RMB headwind to their operating profit. See, that threatens to completely derail their whole margin expansion narrative.
Which is why they immediately followed up with a very bold promise. They committed to offsetting that entire 500 million RMB impact by aggressively cutting regular operating expenses elsewhere in the business.
Okay, I have to throw a massive red flag here.
I figured you would.
Whenever a management team tells Wall Street, yes, we are spending a fortune on experimental new technology, but don't worry, we'll just cut costs somewhere else so your profit margins stay intact, I get incredibly nervous. It sounds like financial engineering. Where exactly are they finding 500 million RMB to cut without suffocating the core business?
They claim primarily in sales and marketing and administrative bloat. But your concern is completely valid. You cannot cut your way to user growth.
Right.
If you slash the marketing budget too deeply, you risk choking off the top of the funnel. If Bilibili stops acquiring new users, the 115 million daily active user base will slowly atrophy.
Especially considering the natural churn rate of literally any consumer platform. So the real question is, do we trust them to execute this high-wire act? Can they simultaneously build out 1 billion RMB AI infrastructure, cut 500 million in marketing and administrative costs, and still maintain user growth?
If this were a company with a history of undisciplined spending, the market would punish the stock instantly on that guidance alone. But this is where the historical context of their 15-quarter margin expansion serves as a shield.
They've bought some goodwill.
They've spent 4 years proving to institutional investors that they know exactly how to wield the scalpel.
So they have earned the benefit of the doubt.
And honestly, the data supports it. In this Q1 report, their sales and marketing expenses actually decreased by 1% year over year. Yet, despite spending less on marketing, their daily active users remain stable, their total user time spent jumped 19%, and their ad revenue jumped 30%.
That's compelling.
They have empirically proven that they can drive deeper engagement and massively higher monetization without relying on paid user acquisition.
So they are relying entirely on organic growth. The quality of the content is drawing people in and keeping them there for 119 minutes. The AI creator tools they're rolling out have to be a big part of this too.
Oh, absolutely.
The CEO mentioned that daily active creators grew 6% and daily submissions grew 19%. So they're lowering the barrier to entry for content creation, ensuring a constant supply of high-quality video without having to pay for it out of their own pockets.
They are trusting the ecosystem to self-propagate. And because of this confidence, they reaffirmed their long-term financial targets, aiming for 40 to 45% gross margins and 15 to 20% operating profit margins.
Currently, they're sitting at 37.1% gross margin and roughly 7% adjusted operating margin. So they still have a substantial mountain to climb to hit those long-term targets, but the trajectory is undeniably pointing in the right direction. And more importantly, management put their money where their mouth is regarding the valuation of the company.
The share buyback program. This is the ultimate signal of capital discipline. The transcript details that they completed a $200 million share buyback program in Q1, repurchasing and retiring 9.9 million shares.
Yeah.
Furthermore, the board is already considering authorizing a new buyback program.
For you, the retail investor, understanding the mechanics of a share buyback is vital. Look at it this way. When you own 100 shares of BILI, you own a specific percentage of the total outstanding equity, right?
Right.
When management uses the cash generated by those AI-optimized ad revenues to buy shares on the open market and destroy them, the total number of outstanding shares decreases. So without you lifting a finger or investing another dime, your 100 shares suddenly represent a slightly larger ownership stake in the company.
And a larger claim on all future cash flows.
Exactly.
It is the final stage of the corporate maturation narrative. Think about it. A young, unprofitable growth company constantly issues new shares to raise capital, which dilutes the existing investors.
Right, they print stock.
But a mature, highly profitable company uses its excess free cash flow to buy back shares, actively rewarding the existing investors. Bilibili's completion of a $200 million buyback signals that they truly believe their transition from a cash-burning startup to a cash-generating machine is permanent.
Which brings us to the ultimate verdict. We have dissected the X-ray, we have looked at the massive surge in advertising, the structural weakness in gaming, the aggressive AI infrastructure spend, and the ruthless cost-cutting. What is the bottom line for the listener managing their portfolio?
Based comprehensively on the data in this Q1 transcript, my stance is decisively but cautiously bullish.
Okay, let's break down the bull case first. Why should someone hold or accumulate?
The bull case is anchored completely in execution. You have a management team that has delivered 15 consecutive quarters of margin expansion in a very volatile macroeconomic environment. You have a highly successful, demonstrably proven pivot toward high-margin advertising, fueled by an AI integration strategy that is actually generating hard ROI, not just, press releases.
Right.
They are successfully monetizing an aging demographic that has transitioned into household decision-making power, evidenced by that 130% explosion in home decor ad bookings. Add in a management team committed to returning capital via buybacks, and you have a highly disciplined, deeply undervalued asset.
The narrative has fundamentally changed. If you are holding BILI, you have to stop valuing it like a hyper-growth tech startup trying to conquer the world and start valuing it as a highly sophisticated, margin-focused ad tech platform harvesting the disposable income of a fiercely loyal demographic.
But the caution is equally important here. The bear case cannot be ignored.
The gaming division.
Yes. A 12% revenue drop is a structural vulnerability. If the upcoming summer and fall launches, specifically N-Card in July and LumiMaster in Q4, fail to resonate with the market, the gaming division will become a permanent drag on the balance sheet.
It's an anchor.
You cannot expect the advertising division to indefinitely subsidize a collapsing gaming arm while simultaneously trying to reach a 20% operating margin.
So the actionable takeaway for you listening is clear. If you own BILI, you need to set Google Alerts and monitor App Store ranking data for N-Card in July and LumiMaster in November. If those games launch and immediately fall out of the top 50 grossing charts, that is your immediate red flag that the internal game development pipeline is broken. You must verify that they can still manufacture cultural hits, not just optimize ad algorithms.
Because an algorithm can only optimize the traffic that already exists. It cannot create the cultural relevance that brings the traffic in the first place.
Which leads perfectly into a final existential thought I want to leave you with today. We've spent this entire analysis celebrating the fact that Bilibili's users have aged up. The teenagers who joined in 2014 to watch anime are now 26-year-olds buying couches and EVs.
Right.
Bilibili is capitalizing on that disposable income brilliantly, and it is the sole driver of their current profit explosion.
It's the absolute foundation of that 30% ad growth.
But there is an inherent long-term danger in aging alongside your user base. What happens in 5 years? What happens when these core users are 31, they're married, they have toddlers, and they no longer have 119 minutes a day to spend watching deep dive video content? By catering so heavily and so successfully to the users who joined a decade ago, is Bilibili inherently alienating today's 14-year-olds?
It is the innovator's dilemma applied to digital communities. I mean, Facebook faced it when the parents joined and the teenagers fled to Instagram. Instagram is currently facing it as the millennials age and the youth move to TikTok.
Exactly. Think of it like a physical destination. If a mall slowly replaces all of its arcades and skate shops with high-end furniture showrooms and boutique appliance stores, sure, it becomes incredibly profitable in the short term. The adults spend thousands of dollars, but the teenagers stop hanging out there because it's simply no longer built for them. They find a new arcade.
And once the youth culture abandons a platform, the cultural relevance inevitably decays.
So the question you have to mull over as a long-term investor is this. Is Bilibili fated to just ride this specific demographic wave? Are they just going to harvest this current generation's disposable income until it crests, eventually losing their crown as the undisputed hub for the young generation in China? Or can management figure out the impossible platform balancing act? Can they sell smart refrigerators and EVs to the 26-year-olds while simultaneously cultivating a vibrant, chaotic, highly relevant subculture for the next generation of teenagers?
Because if they cannot do both, then this incredible surge in operational profitability might just be the financial peak of a platform that has already passed its cultural zenith.
It requires looking past the 10x profit growth and questioning the 10-year cultural horizon. Is it a permanent, sustainable machine, or is it just the most efficient harvesting of a singular generation? That is the question you have to answer before you decide what to do with your shares. Thank you for joining us on this deep dive. We'll see you next time.